Okay, this is Intermediate Accounting 2, Chapter 20, Lecture number 1, where we're going to talk about accounting changes. We're also going to talk in this chapter about error corrections. And there's different categories these all fall into on page, well, really 1159, but really it starts on page 1160. So the different types of accounting changes that can occur, change in accounting principle. So this would be changing from one GAAP principle to another. Okay, this could be change of cost versus equity method. This could be change of inventory method, which is one of the main ones we talk about in this chapter, or adopting a new accounting standard. That's one type of change. A change in accounting estimate. This would be like change in my depreciation method, change in my estimated useful life for depreciation, change in residual value, change on estimate of periods benefited by an intangible asset, change in actuarial estimates pertaining to a pension plan. So this would be correcting, not necessarily an error, though it kind of is an error in a way, because my estimate that I initially set forth in the first place, I found to be either incorrect or not as accurate as I wanted it to be. And then a change in reporting entity is a change from reporting as one type of entity to another type. So like consolidating a subsidiary, not previously included in consolidated financial statements, or report consolidated financial statements in place of an individual statement. An error correction is another one, correction of error. Correction error caused by transactions that's recorded incorrectly or not at all. Could be mathematical errors, incorrect physical inventory count, change from a cash basis to accrual basis, failure to record an adjusting entry, fraud or gross negligence. So the different approaches that we can use, and we'll talk about all three of them in this chapter. The first is a retrospective approach. A retrospective approach offers consistency and comparability because we reflect the changes not only in our current financial statements, but in our historical financial statements. Most of the time this is done through retained earnings. It just kind of depends. But effectively what we want to do is, if we've decided to make a change, we want to make sure that when someone looks at the set of financial statements that they're using to make decisions, that they're comparable, meaning if I change to, if I change over to FIFO and I used to be using weighted average, that both set of financial statements represent what a FIFO method of inventory would have, even if last year I was using a different method. That's an example of a retrospective approach. A modified retrospective approach on page 1161 requires application of the new standard only to the adoption period, that is the current period, as well as the balance of the retained earnings at the beginning of the adoption period to capture the cumulative effects of prior periods without actually adjusting numbers in the prior reported period. This is probably the one I see most frequently because it's a little less work than going all the way back and restating all your financial statements. And then there's the prospective approach. So nothing needs to be done to prior year's financial statements, nor a journal entry to adjust account balances. Instead, the change is simply implemented in the period of change, and it's reflected in financial statements in the future periods. So that's a prospective approach. I'm only looking at the future, not going backwards at all. So a change in accounting principle. Although consistency and comparability are desirable, changing to a new method sometimes is appropriate. For example, management could choose to use accelerated or straight line depreciation. They could also choose to use LIFO, FIFO, or average cost for the inventory method. And then they can, if economic conditions changes, they can decide to change that, okay, or go to a different method. It's not that uncommon for a company to switch from one accounting method to another, and this would be what we consider a change in accounting principle. So the retrospective approach, this is on the bottom of 1162 and over onto 1163, we report most voluntary changes in accounting principle retrospectively, meaning we report all previous periods financial statements as if the new method had been used in all periods. So an example we have here on 1163, illustration 20-3, Air Parts Corporation used the LIFO inventory costing method at the beginning of 2018. Air Parts decided to change to the FIFO method. Income components for 2018 and prior years were as follows. So we have our differences here. And you see that our cost of goods sold is really where our main difference comes in. Obviously, we'd also have differences on the value of our inventory as well. But retrospectively speaking, the main place that ends up is in our retained earnings because it goes in through our net income. So you can see that we have a $60 million difference in 2018, 55 in 2017, and 45 million in 2016, for a total of $300 million. So Air Parts has paid $40 million each year beginning in 2011, or dividends, excuse me, of $40 million each year beginning in 2011. The income tax rate is 40%. Retained earnings was $700 million, and inventory was $500 million. So then we go on to look at what the revised comparative financial statements would look like. So for each year, Air Parts would make those statements appear as if the newly adopted method, FIFO, had been applied all along. Comparability is one of the important qualitative characteristics of accounting information, which is why we do this. If I'm going to show 3 sets of financial statements, then it is ideal that I can compare one to the other to restate all of them. So the company would recast the comparative statements as if they adopted FIFO all the way back in 2016. Inventory would also need to be adjusted because FIFO usually produces a lower cost of goods sold and thus a higher inventory than LIFO does. Retained earnings would also need to be adjusted. Air Parts will report retained earnings by FIFO each year as well. Retained earnings is different because the 2 inventory methods affect income differently, because cost of goods sold by FIFO is less than LIFO income, and therefore retained earnings is earnings by FIFO are greater than LIFO. Now, honestly, while that is true and that is generally the case, really what matters is whether my change in method increased or decreased my cost of goods sold and my inventory, that balance between the two. And they'll tell you that, generally one is higher and one's lower, but all that really matters is to compare and see what actually happened. So on 1164, you see the effects of switching to FIFO. So FIFO has my cost of goods sold being lower, which means a cumulative net income increases each year by the annual tax after tax difference. Inventory, pre-tax income, income taxes, and net income and retained earnings are all higher. So you look at the comparative balance sheets now, and in 2016, we report $345 million higher than was reported in last year's statements. Likewise, 2017 will increase by $400 million. And inventory in 2018, we reported for the first time is $460 million, higher than it would have been had the switch not occurred. So we should always disclose this. Okay, we need to write a disclosure note, and talks about that there in the next part of 1164. That we write a disclosure note to disclose this change, but we also need to write a journal entry to account for this difference. So you can see on 1165 what that journal entry looks like. So inventory would have been $400 million more, and the cumulative earnings, prior earnings, would have been $240 million more if FIFO rather than LIFO had been used. So my retained earnings, that causes my retained earnings to go up by $240 million, my inventory to increase by $400 million, and then therefore my income tax payable, which is the $400 million inventory difference times the 40% for the income tax payable for $160 million in total. Notice that the tax effects is reflected in the income tax payable account. The reason is that, unlike for other accounting method changes, the Internal Revenue Code requires that inventory costing methods used for tax purposes be the same as used for financial reporting. For that reason, tax code allows a retrospective change in inventory method, but then requires the taxes saved previously, which in this case is $160 million, from having used another inventory method, must now be repaid. However, taxpayers are given up to 6 years to pay that tax due. As a result, this liability has both a current portion payable within 1 year and a non-current portion payable after 1 year. Okay, and then it goes into the disclosure note, which I'll let you read. So the modified retrospective approach, when FASB is the one that is responsible for the change in accounting principle, the most common method is the modified retrospective approach. Usually what this means is that we apply this to the adoption period, the current period, and then adjust the balance of retained earnings at the beginning of the adoption period to capture the cumulative effects of the periods without actually adjusting the numbers in the prior period. So this one, while last one we adjusted inventory and retained earnings and my income tax payable, this one we would only really be adjusting the retained earnings to adjust it to be correct based on our change. The prospective approach, on the other hand, the last one here, 1166, is when retrospective is impractical, okay, if it's too difficult to do, lack of information or otherwise, we can do this prospectively only, which means we would only report this in future periods and not go backwards at all. So a new accounting standards update specifically requires prospective auditing or accounting, if a new accounting standard update specifically requires prospective accounting, that requirement is followed. So for instance, page 1167, if for a change from the equity method to another method of accounting for long-term investments, GAAP requires a prospective approach. Why that is generally because when investors' level of influence changes, it's not necessary to change the equity method to another method. For example, if the sale of shares causes investors' ownership to fall from 25 to 15, resulting in the equity method no longer being appropriate. When that situation happens, no adjustments made to the remaining book value, sometimes called the carrying value, the carrying amount investment. Instead, the equity method is simply discontinued, and the new method is applied from then on. The balance in the investment account when the equity method is discontinued would serve as a new cost basis for the writing investment up or down for the fair value for the next set of financial statements. Okay, so let's look at a couple of problems. I'm going to look at brief exercise 20-1 and 20-4 on page 1184. So 20-1 says, in 2018, Barton and Barton Company changed its method of valuing inventory from FIFO method to the average cost method. At December 31st, 2017, B&B's inventory were $32 million under the FIFO method. B&B's records indicate that inventories would have totaled $23.8 million at December 31st, 2017, if determined on an average cost basis. Ignoring income taxes, what journal entry would B&B use to record the adjustment in 2018? So first thing, we got to find what the adjustment is going to be. And the adjustment is going to be the difference between 32 million and the 23.8 million, so 8.2. So inventory has gone down substantially, which means if my inventory goes down, my cost of goods sold then would go up. My cost of goods sold goes up, so just to be clear here, my inventory goes down, that means my cost of goods sold goes up. If my cost of goods sold goes up, then my net income goes down, right? So higher cost of goods sold will result in a lower net income, which means my retained earnings should be reduced. So for the journal entry here, our debit and our credit, we would debit retained earnings for 8.2 million, and we would credit inventory for 8.2 million. Okay, now I want to look at brief exercise 20-4. And this one's going to be a little strange because we don't deal much with sum of the year's digits, so I'll do a short review on how to figure sum of the year's digits for a depreciation method. But let's read the problem real quick first. So Irwin Incorporated constructed a machine at a total cost of $35 million. So $35 million is the asset cost. Construction was completed at the end of 2014. The machine was placed in service beginning 2015. Okay, so it's good to know. So 2015 was the first year. Was year one. Okay. The machine was being depreciated over a 10-year useful life with sum of the year's digits. Now, sum of the year's digits, and this is the one that I think you might not remember, you need to basically sum every year. So 10, 9, 8, 7, 6, 5, 4, 3, 2, 1, which is a total of 55. And then the first year, you would take 10 divided by 55, and multiply that by the depreciable cost. Year 2, you would take 9 divided by 55 and take that divided by, or times the depreciable cost. So, for example, depreciable cost, let's figure depreciable cost real quick. Depreciable cost is the asset minus the residual value, the asset cost minus residual value. So residual value is expected to be 2 million. So the depreciable cost is 35 minus 2. So I can take 33 times this number. To get how much depreciation I would have every year. And notice the total depreciation is 33 like it should be, in the total depreciable cost. So if I use some of the year's digits the whole time, this would be my depreciation. I would do this for year 1, this for year 2, this for year 3. So the issue here is, it goes on to say, at the beginning of 2018, they decided to change to a straight line method. What journal entry should Irwin record relating to the machine? So this one would be done in a prospective approach. So the first step I need to do is I need to figure out exactly how much I've depreciated this already. So I need to figure out the accumulated depreciation to date. Well, we started in year 1, so that's 2015, 2016, and 2017, and then they are starting in the beginning of 2018 with the straight line method. So my depreciation at this point, my accumulated depreciation is the sum of those 3. That is 16.2 is my accumulated depreciation. So now I can figure out how much depreciation is remaining. So cost minus accumulated depreciation gives me my book value. It could also be known as my book value. Okay. So now I can figure out how much needs to be depreciated over its remaining useful life. Well, I have 18 million left to depreciate, but I need to take out the residual value to know that 16.8 is how long, is how much more needs to be depreciated. Well, I've got 7 years remaining, so I use that 16.8, and utilizing the straight line method, I depreciate that equally over the next 7 years. So years remaining, 7. Oops. 7. So my annual depreciation for the next 7 years is 16.8 divided by 7. So this is depreciation per year from this point forward for the next 7 years. It asks us to journalize this for 2018. And since we're only doing this prospectively, we don't need to worry about doing anything with retained earnings. This is simply a depreciation entry for the year 2018, since it's a prospective approach. So I would, as usual, debit depreciation expense and credit accumulated depreciation. For 2.4 million that we just found. Okay, and that will be all for this video for chapter 20, lecture number 1.